Federal Drive is presented by GEHA, Government Employees Health Association, proudly providing health and dental benefits to federal employees and their families. Visit GEHA.com.
And now, the Federal Drive with Terry Gerton, sponsored by GEHA.
Welcome to the Federal Drive on Federal News Network. It's Wednesday, May 13th. I'm your host, Terry Gerton, and I'm glad you're here. Coming up on this hour of the Federal Drive, managing disaster risk is about how risk is understood, priced, and communicated across the system. Plus, the size of the federal grant system is well known, but how well it's set up to manage that scale is another question. Those stories and much more ahead during this hour of the Federal Drive. We begin with this. The Postal Service generally pays its own bills through its own revenue. That's been the way it's operated for more than 50 years. But the agency is floating the possibility of Congress stepping in to provide more financial assistance to keep them from running out of cash early next year. Federal News Network's Jory Heckman is here with more details. Jory, thanks for joining me.
Hey, Terry. Great to be here.
Hey, the Postal Service has had cash problems for years now. They've talked about all kinds of challenges. What's new?
What's new is that there is a plan forward, or perhaps several paths being proposed here. This is all coming from the USPS Postmaster General, David Steiner. Last week was the rollout of the agency's second quarter financial results, and usually that is a pretty pro forma meeting. They say, here's how much money we lost, here's how much mail we delivered. But this had a little bit more substance to it. This was Steiner, one, recognizing that, as he's told lawmakers already, that the Postal Service is close to running out of cash and will get close to that financial cliff sometime in early 2027. That's if USPS pays all of its bills, and it has relied on some extraordinary measures to avoid running out of cash and has been delaying some of its bills. But Steiner really did float a couple of options, largely for Congress to consider for the short-term future, what lawmakers could do to step in and help the Postal Service out.
What is the Postmaster General proposing as far as changes to the Postal Service business model?
Well, the way he describes it, USPS and lawmakers could go down one of two paths here. Option one would be USPS not really getting any additional financial assistance from Congress. What this would mean is that lawmakers, the ask would be that they would eliminate some of the mandates that ensure USPS loses money. This is coming from Steiner. This would mean giving USPS greater flexibility to close unprofitable post offices, slash days of delivery, and reduce service standards, all while having more flexibility to raise prices for its monopoly mail products and for packages. And Steiner says this is something that would certainly have some drawbacks. Days of delivery being cut has been something that has been a third rail for USPS in the past. Other postmasters general have proposed it. It has been swiftly rejected by Congress and the public. But he says that that's just one way they could go down. And option two is Congress giving the agency more robust funding than what it has been getting. And this would be USPS getting somewhere in the neighborhood of $460 million annually. They get about a tenth of that amount for a program for people who are legally blind to send and receive certain items in the mail for free. And so USPS has kind of gotten this nominal appropriations for years and years, but they're asking for substantially more if they go down this Plan B route, and this would be what's called a public service reimbursement.
Either of those getting any kind of positive reaction from folks on the Hill?
Well, we haven't heard anything from them just yet. Steiner did say that this is somewhat preliminary, that they are working on a congressional wish list for really the rest of this month, and that they're going to have something a little more formal brought to lawmakers after that time. So this is just Steiner kind of giving a heads up of what to expect. There's no official plans for anyone to contemplate, but this is kind of a crossroads for USPS. They have been dealing with financial problems for a while now, somewhat in the neighborhood of 15 years or so, where they've been posting these pretty substantial net losses every year. That's a product of the fact that USPS is delivering less mail than it used to. It's its most profitable product, the first class mail, and that has been in free fall. This is something that has been seen year over year declines, but what we saw in 2008 is that the recession had a big acceleration effect on mail declines, and the COVID-19 pandemic likewise has had a similar effect to mail volume, that just it goes down faster and it doesn't come back. So these are the options that USPS is laying out here.
And it sounds like the Postal Service would require congressional engagement to change any of this. Any chance that they could turn it around on their own?
The USPS is saying there's really not that much likelihood of that succeeding. To give you an example, USPS did report seeing a $2 billion net loss for the second quarter of fiscal 2026. And they saw similar results in the first quarter of fiscal 2026. That's usually the best quarter that they have because that reflects the business that they do every peak holiday season. So also, USPS is midway through its 10-year reform plan. Under that plan, the goal was to get to a break-even point, and so far they have gotten far below that target.
So besides money and flexibility, what else does the USPS want from Congress?
Well, there have been a couple of things on its wish list for a while, and they've been pretty vocal about that. First things first, they want a greater borrowing limit from the Treasury Department. They have currently maxed out their $15 billion line of credit with the Treasury Department. They say that they need more money, like any business would, a greater line of credit to do the kinds of infrastructure upgrades that they are focused on, buying a next generation delivery vehicle fleet, modernizing some of the facilities across the country, largely with the goal of getting efficiencies in there, doing more with less, and being able to deliver a greater volume of packages and compete with private shippers like Amazon and UPS. One other thing here is that they're also asking for Congress to give them greater flexibility to invest their retirement funds in. Currently, they are limited to only investing those funds in low-risk, low-reward Treasury bonds. This is something that the Inspector General has looked at closely, and they found that if USPS was able to invest its funds in an even mix of bonds and stocks like other agencies are able to, that they would actually be in a very different financial situation. They'd actually have a $800 billion surplus in that retirement fund.
Well, it sounds like there's lots to watch here and lots of discussion yet to come.
A lot to come, for sure.
That's Federal News Network's Jory Heckman. Jory, thanks for joining me.
Thanks, Terry.
You can find the full story at federalnewsnetwork.com. Up next, managing disaster risk is about how risk is understood, priced, and communicated across the system. This is the Federal Drive with Terry Gerton on Federal News Network.
Tune in Tuesdays at 10:30 a.m. and 2:30 p.m. for the Innovation in Government Show, sponsored by Carasoft. Hear from the industry leaders advancing the technologies shaping how agencies modernize secure operations and deliver better services. Innovation in Government covers what is changing now, what is working from cybersecurity and cloud to data, AI, and emerging technologies. Listen to Innovation in Government, Tuesdays at 10:30 a.m. and 2:30 p.m. on Federal News Network. Search Innovation in Government.
Welcome back to the Federal Drive with Terry Gerton on Federal News Network. Insurance pricing plays a powerful role in signaling where disaster risk is increasing and where the federal government is increasingly exposed when coverage breaks down. We'll examine a proposal that would bring the federal government into the reinsurance market, how that could affect those signals, and what questions leaders should be asking before shifting risk further upstream. Professor Ben Collier of the University of Wisconsin is here to guide us through those questions. Professor Collier, thank you so much for joining me today.
Thank you for having me, Terry.
There are reports of homeowner insurance companies pulling out of markets across the country. So talk to me first about the risks this industry is facing that is driving this kind of behavior.
There's been a lot affecting the insurance industry in the past few years. To name a few things, there's a broader perception that risks are increasing that insurers cover: wildfires, hurricanes, severe thunderstorms, hail, and so on. There's a number of other challenges too. The cost of rebuilding a home has gotten more expensive in the past, is one of the others. So there's a kind of confluence of issues affecting this industry. And many people are feeling that in terms of rising premiums. And in some cases, homeowners have to go find a new insurer because their existing one won't cover them anymore.
So you and your colleagues are proposing the establishment of a new federal reinsurance entity. First question is, how does the reinsurance market work?
Reinsurance is insurance for insurance companies. A local insurance company operating in a high-risk area, so an area like a coastal community affected by hurricanes or a community affected by wildfire risks, for example, that local insurance company can't manage the risk of a big catastrophe there very effectively because so many policyholders will be affected at the same time. So these local insurance companies buy reinsurance from these global firms that are able to spread that disaster risk across a globally diversified portfolio.
What gap then would a federal reinsurer be meant to fill?
One of the challenges of these growing climate risks is that the size of these events seems to be increasing substantially. And so think of more severe hurricanes than in the past, record-breaking wildfires, and so on. And the reinsurance industry has trouble fully smoothing out diversifying U.S. catastrophe risks. When a big event occurs, the industry needs to pay billions of dollars in claims, and that's challenging for this industry to do. They have to set aside large amounts of capital in preparation for those events. And when one occurs, it affects the available capital in that industry. And so as a result, the prices for reinsurance coverage for these events tends to be high, and it tends to vary over time. Big spikes in prices following historical catastrophes like Hurricane Andrew, Hurricane Katrina, the 9/11 attacks. We've seen a run-up in reinsurance prices since around 2017 when Hurricanes Harvey, Irma, and Maria occurred, the Camp Fire occurred in California. And since then, we've seen large price increases that have then been passed on to consumers in higher risk areas as well.
How would the government moving into this space be different from what it's currently doing today? It offers flood insurance, for example.
So there are a number of countries around the world that have the kind of entity that we're proposing, which is this reinsurance entity is distinct from an insurance company that you or I or other households might go to buy insurance from directly. In flood insurance, people are buying products directly from the National Flood Insurance Program. For this type of government reinsurance industry, it would be a backstop to the insurance and the reinsurance sector. So you as individuals wouldn't be interacting with this entity. This would be something that's covering the really severe catastrophes instead of relying exclusively on the private reinsurance industry to provide the funding for those.
You mentioned that there are institutions like this in other countries. Isn't the United States kind of unique in this space, just given our size, our geographic diversity, our exposure to such a variety of natural disasters?
We are unique in many ways, and the U.S. is large compared to many other countries. It's more geographically diversified. It's higher income than much of the world. It also has more disaster risk. This has meant that a lot of the global reinsurance risk is U.S. disaster risks that are being held by those entities, and that has limited that industry's ability to fully smooth out those risks and is part of what's driving to the higher and volatile costs of reinsurance in the U.S.
I'm speaking with Professor Ben Collier. He's an associate professor of risk and insurance at the University of Wisconsin. Professor Collier, I feel like I have to ask, though, don't we want those risks to be reflected in the market? I mean, there are some places you just probably shouldn't build a house anymore. Does this idea of the government stepping in to balance that risk mitigate the market signals that we actually want to have people respond to?
I think that's a great question. And one of the things that we would want to make sure in creating an entity like this is that the prices that people are paying still reflect their underlying risk. Roughly, think about two different types of expenses going into homeowners insurance premiums in these high-risk areas. One is the risk of damage to your specific property, and there's a cost to that, and insurance provides a price signal related to that risk. And there's another piece that of insurance that people are paying for, which is that when a catastrophe occurs, the insurer needs to pay potentially billions of dollars in claims at one time, and holding all of those funds in check for the next catastrophe. That part is also extremely costly, and that's the part where a government reinsurer could help make progress in lowering those costs.
When you think about federal agencies that are already managing disaster response missions or housing or infrastructure investment, what would this model change for them operationally, not just in theory, but how risk gets assessed and managed upstream?
So I think there's two real challenges for homeowners that this proposal could help address, and that would then be important in terms of mortgage markets and other markets as well. One is that the price of dealing with these catastrophic losses, having to pay claims, large amounts of claims at once, like this entity should reduce some of those costs and also make covering those catastrophes, the price of that covering those catastrophes, less volatile. And so the goal here is that this is reducing the additional costs that are added to homeowners insurance for individual consumers and making those additional costs less volatile. And that should be helpful in making sure consumers can pay their bills, can access a mortgage, can sell a house if they need to. The goal here is to try to provide a shock absorber that helps stabilize insurance prices.
Speaking of that shock absorber function, one of your proposals specifically says that the U.S. reinsurer should have clear authority to pay claims and political independence in setting prices. We're seeing a lot of action around the political independence of certain kinds of organizations in our government right now. How essential is that to the effective function of a U.S. reinsurer? And would you have any concerns about that?
Great question. And I think part of the history that informs so many people's views of insuring catastrophe risks is the National Flood Insurance Program, where for a very long time it was limited in its ability to price risk. There was it didn't operate with independence, and that this actually created challenges with encouraging people to move out of harm's way or to improve their home and so on. And I think there's a long legacy there that we hope this entity would not fall into. The independence seems crucial for ensuring that it's pricing risk and not creating a similar type of distortion. And we certainly have examples in the government of independent entities. The Federal Reserve is one of those examples that has some arm's length ability to operate. And I think concern for us would be that if this entity, US Re, did not have independence, that it could create harm instead of doing good, and that if it's underpricing risk, encouraging people to live in harm's way, that would be a problem.
Well, with that as a background, then, as federal leaders would weigh ideas like this, what questions should they be asking to decide whether a new risk-sharing mechanism is worth pursuing, especially in environments where we have rising disaster costs and limited public resources?
Our intent with this entity, or what we describe in the proposal, is that this is a budget-neutral entity where it would leverage the government's ability to absorb large shocks in a way that the reinsurance industry can't, but that the users of that program would pay for it through reinsurance premiums, which are ultimately affecting people's insurance premiums, but are reducing those insurance premiums overall relative to relying on the private sector alone. So the goal here would be that this would be an entity that, if priced correctly, would be budget neutral. That this is something that, really do think it's central to be thinking about the independence of this entity and the ability of it to price risk, because that pricing risk is fundamental to encouraging adaptation to growing risk.
I've been speaking with Ben Collier. He's an associate professor of risk and insurance at the University of Wisconsin. Professor Collier, thank you so much for joining me today and for explaining this proposal. We'll see how it pans out.
Thanks so much for having me.
We'll post this interview at federalnewsnetwork.com/Federal Drive. Listen to the Federal Drive on your schedule. Subscribe wherever you get your podcasts. Still to come, receiving federal funds now comes with a different kind of risk calculus for grantees. But first, the size of the federal grant system is well known. How well it's set up to manage that scale is another question. You're listening to the Federal Drive with Terry Gerton on Federal News Network. Welcome back to the Federal Drive with Terry Gerton on Federal News Network. As the federal government takes on more financial risk, A GAO review of government-wide grants management points to staffing limits, data mismatches, and unclear rules that complicate how funds are awarded and overseen. The findings suggest persistent operational challenges that accounting fixes alone haven't solved. Jeff Arkin is Director of Strategic Issues at the Government Accountability Office. Jeff, thanks so much for joining me. It's great to have you back.
Thanks, Terry. Great to be back.
We're going to talk about grants management today. That has been a perennial topic in GAO reports. You've looked at it across administrations, across various crises, and you've got a recent report out, again, looking at the challenges in grants management. So before we dig into what you found in this particular report, let's talk first about what makes federal grants management so complex to start with. Set the stage for us.
Sure. I think there's a couple things in play here. When we talk about grants management across the federal government, we're talking about dozens of agencies that are managing over 1,000 different grants programs. They have different goals. They're trying to provide money to different types of recipients. And so there's just a ton of moving parts. And the other aspect of it is there are a lot of requirements that agencies are supposed to follow. You have federal laws, you have regulations, you have guidance from the Office of Management and Budget, and then you have agency policies and requirements that they have to follow. So just a lot that the agencies have to take into account.
And the report notes that the federal government issued $1.2 trillion in grants in 2024. It's more than the rest of the appropriations budget put together.
Right.
So you can't put it all in one little box.
That's right. Yeah, it is a lot of money. It's, in some years it's getting close to 20% of federal spending. And that's something that maybe we don't think about, that it's a large amount of money and it's going through agencies that they are then providing to recipients, whether it's states or localities, universities, nonprofit organizations, to really implement policies and to implement the goals that we are trying to achieve as a federal government.
When we at the federal government have tried to reform grants management, it seems like we try to take a financial approach to this, solve it as an accounting problem. But your report really points out that there are a lot of operational issues that have to be addressed. So is the government asking the wrong question about grants management? Are we looking in the wrong place?
Yeah, I think I agree that it really is an operations challenge. Certainly there are financial or accounting measures that have to take in place. But these are, grants are things where there's a lot that the agency have to take into account. They have to make sure that the grants are and the grantees are consistent with the law, that the entities that are receiving the funds are the ones that should be receiving the funds. They have to go through a selection process with grants that are what we call discretionary in nature or competitive grants. They need to make sure that there are or try to mitigate any sort of improper payments or fraud. And so there are a ton of operational challenges that agencies really have to be mindful of and try to mitigate as they implement the grants management process.
Maybe one of the biggest operational challenges there is staffing, and your report highlights shortages in trained grant personnel and really uneven experience across agencies, perhaps made even worse by the personnel transitions of the last year. When you looked across the system, did you get a sense that much of it was being held together by individual expertise rather than repeatable processes?
I think it's probably a little bit of both. Agencies, they certainly have processes that are in place. Some longstanding agencies do change their processes. And again, this is to comply with the various laws and requirements and regulations. But it's really important that agencies ensure that their staff have the skills to administer and oversee grant programs. And a big way of doing that is through the training aspect. In the past, we've found examples where agencies can improve how they manage and train their grants workforce. Issues as simple as really having an understanding of who all the people are at your agencies who work on grants to make sure that they receive training, and also challenges with evaluating training, making sure that the training is effective and helping the individuals achieve the goals of the agencies and ultimately of the statutory purposes for having that grant program in the first place.
Speaking with Jeff Arkin, he's Director of Strategic Issues at GAO. Jeff, the report then ultimately focuses on government-wide collaboration, and it talks a lot about the Council on Federal Financial Assistance, or COFA. How is that organization working these days?
So the COFA is the most recent of many efforts that the federal government has had to collaborate on grants, to enable the various agencies that issue grants to come together, share best practices, tackle challenges that affect all agencies. It's only been around for a couple of years now, so it's getting started. But we're hopeful and certainly think that efforts like this are important. We are hopeful that it'll help address some of these challenges, and it's really was established to improve coordination, transparency, and accountability of federal grants, to have strategic direction across the government, make policy recommendations, set priorities for government-wide grants-related activities. And from what we found so far, again, it's just getting started, but we had some good input from agencies on how it's working, how it's been able to collectively address or provide input on guidance that the Office of Management and Budget is putting out. And it'll be an interesting issue or topic to watch in the coming years to see really how effective it can be.
One of the purposes of COFA is a shared forum for lessons learned. Has that survived the administration's transition?
I think what we have seen that the COFA is still operating, and they tend to meet. You have one representative from each of the what we call the CFO Act agencies that attend this. You have a representative that serves or represents rather the views of some of the smaller agencies. And they have continued to meet. They have continued to discuss lessons learned. We don't go to the meetings ourselves, but we have seen a number of the information or seminars, webcasts, or whatever that come out through this. And I will say that this effort is being led both by the Office of Management and Budget and the Department for Health and Human Services as the largest grant-making agency in the federal government. And so the input we've got from HHS in particular, I think indicates that things are moving forward.
One of the other issues that GAO often surfaces in its reports is incentives. Are programs structured with the right incentives for compliance and improvement? When you think about grants management, are there the right incentives for agencies to slow down and coordinate, or is it more of a pressure to get funds out the door and that collaboration and coordination comes later?
Yeah, again, this may be an answer where it's a little bit of both. I think we saw during the response to the COVID pandemic, for example, a desire to get money out quickly. And there are programs where there is expectations of when money goes out. Let's say, as an example, programs for educational institutions, just K through 12 schools, where there's a cycle of when the school year happens. And so getting money when the school year is halfway through maybe isn't as helpful as right away. So there are those pressures for sure. But what I think one would hope to see is the structures in place well ahead of time to be able to manage those programs and check all the boxes that the agencies need to check in terms of requirements, but also making sure the money's going to the right place and to those that are best suited to receive it.
The Trump administration has made the prosecution of waste and fraud in benefits programs and grants programs a key part of its agenda. You mentioned upfront the variety of structures of grants programs. Do you see here a tension between trying to make grants programs easy to access for the grantees versus putting the overhead in place, the compliance processes in place to prevent waste, fraud, and abuse?
Yeah, I think that question to me really hits on the greatest challenge, or one of the greatest challenges with grants management, that tension between oversight and burden. You could have a federal employee or grants manager sitting in every institution that receives the grant to make sure everything is going according to plan, but obviously that comes with a huge cost and is quite burdensome. You could just send the money out and not worry about where it goes, but that opens up great opportunities for fraud. And so I think the trick is really finding the balance between those two. How can we have processes that identifies fraud up front and make sure that the money doesn't go to entities that shouldn't be receiving it? Make sure the agencies have processes in place to manage fraud and manage the risk of fraud, I should say. But also that we have processes that allow recipients to focus on the main purpose of a grant, which is to achieve the outcome that the government has said we want to achieve. But again, it is a difficult balance to hit.
In the near term, where do you think the best opportunities are to reform grants management to have better outcomes, but also better management?
One thing where we've seen a lot of activities is in the kind of the upfront part of it, what we call the notice of funding opportunity. That's what agencies put out to indicate we have this grant program, there's a certain amount of money available, we want to achieve this goal. In the past, those have been somewhat complicated to look through. And so a large entity like a state may have dozens of people working on grants, and they know the drill, and they know how to look at the funding opportunity and write a grant proposal. Whereas smaller entities that don't have those resources may struggle for that. And so I think we have seen a lot of attention to not level the playing field necessarily, but to make it easier and more viable for those less resourced entities to be able to compete for grants at the same scale as a larger, better resourced entity.
Well, I'm sure that you will continue to look into this, and there will be plenty of other reports to come.
Indeed.
I've been speaking with Jeff Arkin, Director of Strategic Issues at GAO. Jeff, thanks so much for joining me.
Thanks, Terry. Always a pleasure.
We'll post this interview and a link to the report at federalnewsnetwork.com/Federal Drive. Subscribe to the Federal Drive wherever you get your podcasts. Coming up next, receiving federal funds now comes with a different kind of risk calculus for grantees. This is the Federal Drive with Terry Gerton on Federal News Network. Welcome back to the Federal Drive with Terry Gerton on Federal News Network. A tougher federal anti-fraud posture is changing how grants and contracts are scrutinized, especially when routine compliance decisions come under review after problems emerge. We'll look at where scrutiny is showing up, who's being held accountable, and what recipients are expected to get right with Michael Anderson, counsel at Smith Anderson. Mr. Anderson, thank you so much for joining me on the show.
Thank you for having me. It's wonderful to be here.
We have heard a lot of talk lately about tougher federal anti-fraud postures. Strip away the rhetoric for me, though. What is meaningfully different now from the way that agencies have historically policed fraud in federal funding?
Well, I think the first thing that's meaningfully different is the focus of the federal enforcement. The federal task force largely derives from fraud in state-administered programs that involve federal dollars, but maybe didn't otherwise involve a lot of close federal oversight. Think Medicaid, think food stamp programs, other programs where the federal government is putting in a significant amount of money, but maybe doesn't have direct oversight on exactly how the program is being run or administered. That was really the catalyst for the task force. There were incidents in Minnesota. There were others in California. The president's executive order mentioned still others in different states. So I think that focus on state administered programs is one piece that is different from how the government has historically focused its efforts on fraud in government programs. So I would note that piece right off the bat. I would note a second point, which is that historically federal programs are pay and chase systems. Medicare, Medicaid worked that way. PPP worked that way as well. The basis for that is the public policy of getting the money to those who need it, getting payments to providers to provide medical services for those who need them, getting PPP loans out to businesses that were struggling. And then all of that is premised on the understanding or maybe the assumption that those who are dealing with the government are doing so honestly and that they're cutting square corners. If that turns out to not be the case, then the government has an enforcement mechanism to chase the money that was unlawfully requested or obtained. This task force is inverting that focus a little bit and focusing more on the front end of enforcement efforts, ensuring eligibility requirements, ensuring that certifications are accurate, ensuring that there are minimum standards for fraud prevention that apply before money goes out the door. So it's taking what is historically a pay and chase system and making it more of a threshold review. I think that's another important distinction between this program and how the government has typically enforced.
That is a really helpful framing, that inversion of pay and chase to more of a process-driven prevention model. DOJ is also getting much more active these days. Walk us through what's changing in their approach.
So I think there are a couple changes to DOJ's approach here. I think one change is focusing more on self-initiated efforts. Setting up the fraud task forces. One of them, DOJ, I believe in January, set up an entire division that deals with fraud prevention and fraud enforcement. Those are efforts by the department to build up its own self-initiated investigations. Typically, these investigations, fraud investigations, are often driven by some sort of whistleblower. I think the task force is the government's effort to supplement, not moving away from, but augmenting the whistleblower litigation with the government's data analytics and self-initiated investigations, collaborating between agencies to share information to ensure that the government can identify fraud trends, identify areas where fraud enforcement may be necessary so that the government can develop that piece. I think that's one change. I think a second change is the pace of government investigations. They tend to be very slow. They tend to be very detail oriented, as they should be, but those take a lot of time. And the task force seems to be pushing the department to move a lot faster on False Claims Act cases and maybe also on criminal enforcement.
I'm speaking with Michael Anderson. He's counsel at Smith Anderson. With that set up, Mr. Anderson, let's turn our attention to the folks who actually provide grant-funded services. We often think about Medicaid and food support grant programs as the big players here, but there are universities, there are non-governmental organizations, there are for-profit firms who engage in grant-provided services like workforce development or medical research or something like that. As you think about this change in the fraud prevention environment, what is the top of your priority list of guidance for those who receive federal grant funds to actually deliver beneficiary services?
I think what I would emphasize to those entities is obviously be honest in what is being requested of the government, be knowledgeable about the rules that apply. Doing things the right way initially is the best way to avoid government problems or government enforcement. I would say secondarily, be prepared, right? Have written compliance policies, follow them. That means implementing audit processes if those are appropriate. It means implementing your own data analytics to ensure that money is spent appropriately. It means having internal controls to ensure expenses are proper, and then use those tools to identify and take seriously any potential issues that arise. If those issues do arise and they're investigated, make sure everything is documented along the way, thinking always about how the recipient of federal dollars or provider of services to federal beneficiaries is going to be able to explain what has happened or what is being done to those in government that are scrutinizing very carefully.
Does this change the role of these recipient organizations, leaders or boards? Do they need to get more involved, or is this really a program manager, finance officer problem?
That's really up to how the company wants to run its operations. I think from an enforcement perspective, anyone who is involved in these programs would be subject potentially to government enforcement efforts. They always have been. The real question is how the company wants to run its operations. Does the CEO really have the time and the bandwidth to monitor these programs in compliance with the requirements, or is that better delegated to someone with some expertise in that area who might have a designated role and therefore the time to deal with it? So I would defer to how the companies prefer to run those operations.
You talked a minute ago about what I might call good grant management hygiene, But folks maybe have been grant recipients for a long time. They've always done it this way. Are there things that look like they're compliant that maybe ought to raise red flags in this new environment?
I don't think there's one or two things that would look compliant that may raise red flags. Again, I think the key is to ensure, given the heightened government scrutiny, the key is to ensure that compliance policies and plans are in place, things are documented appropriately, and any money that is received from the government or claimed from the government or spent on behalf of the government, that it can be explained to a government investigator sitting across the table, asking tough questions. If those boxes are checked, odds are the recipient is going to find themselves on the right side of any kind of inquiry or enforcement action. If those boxes are not checked, it's going to be much more difficult.
Are there behaviors or trends that you'd be telling these organizations to be watching over the next 3 to 6 months to see which direction this enforcement is actually going to take?
I think looking for public press releases from the government about the enforcement actions that it's taking is a great way to understand where this is headed. Again, I think the focus is going to be primarily on state or third-party administered federal programs, where the government historically has not had a lot of oversight. But time will tell. And the government's public press releases about indictments, about False Claims Act complaints, about resolutions, that's a great way for companies to monitor where things are heading and how things are progressing.
I've been speaking with Michael Anderson. He's counsel at Smith Anderson. Really appreciate you joining me today.
Thank you. It was wonderful to be here.
We'll post this interview at federalnewsnetwork.com/Federal Drive. Listen to the Federal Drive on your schedule. Subscribe wherever you get your podcasts. House Republicans are demanding more information about the cost of settlements for federal employee disputes with their agencies. A new letter from leaders on the Oversight Committee argues that agencies are settling too often instead of fighting cases they could likely win. But the letter is also coming under scrutiny from federal employment attorneys. Here with more detail is Federal News Network's Drew Friedman. Drew, thanks for joining me.
Absolutely. Thanks for having me, Terry.
What kind of concerns are Republicans raising in this letter?
Well, this letter is coming from Representative James Comer, who is the chairman of the House Oversight and Government Accountability Committee. And he sent this letter to OPM Director Scott Cooper, just raising concerns about what he sees as trends in rising attorney fee payouts, the use of what he's calling sue and settle resolutions in federal employee disputes, and just concerns about how that's leading to increasing costs for taxpayers and for agencies. He says that in looking at the data from entities like the Merit Systems Protection Board, Equal Employment Opportunity Commission, and other agencies, their data shows, according to Comer, that if agencies were to continue litigating these cases where employees are filing complaints rather than simply settling them, then agencies would be more likely to win some of those cases. So he's urging essentially more information from OPM on, the current status of all of this, and just flagging this as a potential investigation that he wants to look into further.
So they're concerned about cost and trends. What are they thinking the impact of those trends will be?
Well, one, yes, is the higher costs to taxpayers, as Comer outlined in his letter, but they're also concerned about other impacts as well, like limited accountability for federal employees. So, for instance, if federal managers, he says, they might be less willing to discipline poor performing employees if it seems like those cases would eventually be resolved through a settlement or a potential reinstatement of that employee. There was also concerns about reduced transparency into misconduct without all of this data being readily available. And then just general concerns about the actions of administrative law judges and other adjudicators who are important parties within these disputes. So there's a lot of impacts that Comer is citing here, but he's looking essentially for more data to kind of substantiate some of these claims and some of the concerns that he's outlined.
Any response to that from maybe employees or their attorneys?
Well, it seems like what we've heard so far from federal employment attorneys is they're kind of questioning the data and, how the story that it's told through this letter. They said that some attorneys, for example, at Tully Rinke said that there is a mistaken assumption in this letter that agencies are biased towards settlements. And in fact, that's not necessarily the case. There's also concerns, for example, one data point at the Merit Systems Protection Board shows that attorney fees accounted for about $11 million during the Biden administration, compared with $3.6 million during the first Trump administration. But when I spoke with Kevin Owen, who is a partner at Gilbert Employment Law, he says that data looking at higher costs in Biden administration versus lower costs in the first Trump administration doesn't really capture the full picture at MSPB because of the context of what was going on at MSPB during the first Trump administration. And he shares a little bit more about that.
During the Trump administration, there really wasn't the presence of an MSPB, and there was that significant case inventory that created a backlog. Therefore, there was really no incentive for agencies to resolve disputes through settlement, because if they got an unfavorable decision from an administrative judge, agencies would just file a petition for review to a vacant MSPB, and it would sit for years. Really, a lot of the liability that agencies were resolving under the Biden administration was carryover liability from the first Trump administration.
And again, that is Kevin Owen, partner at Gilbert Employment Law. He also added, just more concerns about the data and what story it's trying to be told here. He pointed to several significant class action settlements that took place in 2023 and 2024, which would have skewed the data to show, more or higher payments during the Biden administration, when really those cases were ongoing for a much longer time and just resolved in the last couple of years.
Well, that all sounds like really important context. When you put it together with the letter itself, what sort of data is the committee looking for, and what do they think the next steps are?
They're looking for a lot more detailed data across several agencies who all are involved in some way or another with these employee disputes. So that includes records from the Equal Employment Opportunity Commission, the MSPB, the Federal Labor Relations Authority, the Office of Special Counsel, and OPM itself. So a lot of entities here are going to be involved in this data collection and the investigation from Republicans. OPM has a deadline of May 25th, so just about 2 weeks out, to submit all of this data going back over the last 5 or so years to look at the number of employee cases, the costs of all the settlements, trends in the outcomes of these disputes, any data on alternative dispute resolutions, and a lot more. I think what they're trying to do is just, build a case on what they're seeing in the data that does exist, and just trying to see what will come out of this investigation.
And once the committee has all of this data, what will they do?
Not totally clear yet what they would do with this information. It's most likely that they would continue the investigation or some sort of probe into some of the trends they're seeing here. It's possible that they're just expecting to see this data, confirm their assumptions, but I think there may be a bigger picture here of, there's underlying facts that aren't necessarily in the data about how well agencies are litigating these cases, the actual disputes that are involved from employees. So I think there's more to the picture here than just the data itself might show.
That's Federal News Network's Drew Friedman. Drew, thanks for the story.
Absolutely. Thanks, Terry.
You can find all the details at federalnewsnetwork.com. The Federal Drive with Terry Gerton is produced by Eric White and Michelle Sandiford. Our web editor is Stephanie Wright. For the latest updates, stay with federalnewsnetwork.com or follow us on Facebook, YouTube, and LinkedIn. I'm Terry Gerton. Thanks for listening.